Ms. Ansula Kant, Managing Director, World Bank, eminent panelists who participated in today's discussions, members of this distinguished audience, friends from media, I see some of them here, ladies and gentlemen. Today's seminar on global economy, challenges, opportunities, and the way forward was held as a part of the international financial architecture, that is the IFA, and the framework working groups, that is the FWG work streams under India's G20 presidency. As a follow-up to that, we had 3 panel discussions, and I did attend the first one. Thereafter, I could not. I had to go back and attend to some work. But I have been informed that overall, all these discussions have yielded very rich and insightful thoughts on the topics that were listed for today's discussion. Especially, I think the suggestions and the thoughts were mainly centered on financing development and global public goods, on tackling global debt vulnerabilities, and also they focused on key risks to global economy. Now, all these issues are priorities under the G20 presidency of India. I take this opportunity to thank all the participants for enhancing the quality of discussions during the day. I would also like to make a special mention of the participation of the audience through various comments and questions. On the whole, I think we have had a very fruitful and productive discussion today. Policymakers today across the world are grappling with multifarious and intertwined challenges in ensuring post-pandemic recovery in the face of elevated inflation, financial market vulnerabilities, reduced policy headroom, and geopolitical tensions. In this milieu, India's G20 presidency aims at enhancing global cooperation to face such challenges. This is embodied in the presidency theme of Vasudhaiva Kutumbakam, that is one earth, one family, one future. The theme underlines the importance of global public goods for common prosperity of all. Global public goods play a very crucial role in shaping developmental strategies and securing human welfare across borders and generations. Financing them has become a critical issue in the wake of COVID-19 pandemic, the highly unsettled geopolitical environment, climate change, fractures in international supply chains, and tectonic shifts in financial market conditions and global liquidity. Now, what strikes me today is that all these points which I mentioned, these are the same points which come up when we are talking of global debt, when we are talking of other challenges, when we are talking about challenges to global growth, or when we discuss monetary policy as a part of the Monetary Policy Committee deliberations. I think these are problems which are today, they permeate into every discussion because they essentially constitute the challenges that the world faces today. Given the confluence of all these factors, global financial stability is gaining prominence in the hierarchy of global public goods. India's experience has shown how digital public infrastructure can be utilized for advancing financial inclusion and productivity gains through cost reductions. Our sustained engagement in the India Stack and the Unified Payments Interface, that is the UPI, especially during the pandemic and thereafter, has filled us with the conviction that digital public infrastructure like the UPI can become a critical part of global public goods when scaled up beyond national borders. While the UPI has been a public sector-led initiative, It's not necessary that public goods can only be developed and financed by the public sector. The private sector needs to engage in the provision of global public goods, not just because they create an enabling ecosystem for businesses to thrive, but also because they would be commercially viable endeavor. In this regard, it's worthwhile to build innovative design features which private investors find attractive in financing of global public goods. In the investment cascade, keeping in view the very large investment requirements, the trigger financing can come from public investment. This would help in minimizing risk and expanding market access. Subsequent financing needs can be met by the private sector. This is where international capital flows and movements assume importance. Hence, risk sharing should be an important design element in fostering private financing for public goods. In this endeavor, multilateral development banks could catalyze private sector investment through risk-sharing mechanisms. Recent fault lines in global cooperation have led to under-provisioning of global public goods and erosion of economic welfare. Absence of seamless access to COVID-19 vaccines is a case in point. Similarly, the lack of timely financial support and creditor cooperation can explain, even if partly, the rising debt stress in some developing economies. High and unsustainable debt levels have severely constrained many countries, limiting their fiscal capacity. While the G20-led initiatives such as the Common Framework for Debt Treatment and the debt service suspension initiatives have been discussed intensely, significant progress beyond discussions have to be achieved. I would like to make 3 specific suggestions in this context. First, it's essential that debt sustainability analysis for countries is realistic on growth and fiscal projections are fully founded on accurate and comprehensive debt data. A global debt data sharing platform can help in this regard. Establishing such a platform could be very challenging and may take several years. In the interregnum, therefore, we may examine the possibility of constructing suitable proxies for debt flows. Such proxies may be derived from data on capital flows and locational banking statistics from sources such as the Institute of International Finance, IIF, and the Bank for International Settlements, that is the BIS. The second suggestion I would like to make is that a multilateral debt relief program providing targeted assistance to low-income countries with high level of debt needs to be considered on a priority basis. This initiative can be designed with a clear focus on utilization of debt relief for sustainable development projects and poverty reduction efforts. To this end, instruments such as debt for development swaps and green debt relief programs could be employed. Third, the crucial role of International Monetary Fund and the World Bank in addressing global debt vulnerabilities cannot be overstated. These institutions are at the center of international monetary and financial systems. Hence, it is incumbent upon them to do more for countries in debt distress. At present, the International Monetary Fund, that is the IMF's precautionary programs, such as the precautionary lending line, are available for countries with sound macro fundamentals. However, I see little reason for countries with strong macro fundamentals to seek precautionary lines. Further, standby arrangements are offered for countries with a balance of payments crisis. But Standby arrangements come with performance benchmarks and are often attached with some kind of a stigma. This is an important issue as the recent experience shows how the perceived stigma and or lack of access to IMF programs can cause countries to seek support from other borrowers rather than the IMF, with debt sustainability consequences for these very countries. It may be helpful if programs can be designed with less conditionality for countries with macro fundamentals that are not sound but reasonably resilient, if they are not marred by balance of payments stress. The key point that I am trying to make here is that corrective measures, including financing, should be put in place in a timely, non-stigmatized, and more open access basis. For this purpose, a bigger and stronger IMF that is capable of managing the levels of country risk assumes crucial importance. Since the IMF's support is linked to quota size of countries, the 16th General Review of Quotas and its attendant requirements, including governance reform, needs to be completed expeditiously. Besides enhancing the legitimacy of the IMF in its oversight of international monetary and financial system, this will increase traction for the IMF's policy advice. We must not allow the burden of debt to stifle the potential for growth in large number of countries. In this connection, the panel discussion on key risks to global growth, namely inflation, financial stability, and climate change, assume topical relevance. Even as global economic outlook is marred by risks to downside, long-term structural challenges such as climate change must be addressed through supply of adequate and affordable financing for green transition. We must, however, be mindful of the potential financial stability implications of green transition. The transition efforts must address both physical and transition risks of climate change. Smooth and orderly green transition is absolutely necessary to avoid disruptions to economic activity and loss of growth potential. While the investment needs for smooth green transition are large, the actual financial flows to green projects are highly skewed and are by and large concentrated in the advanced economies. There is an urgent need to enhance green capital flows especially to the emerging market and developing economies. As noted by the IMF in its recent Global Financial Stability Report, the green flows to EMDs are curtailed by inadequate supply of green-rated investment projects. While green flows today are dependent on ESG ratings, recent research shows that these ESG ratings do not adequately reflect financial and non-financial materialities of these investments. Therefore, there is a need to ensure that green ratings reflect the actual environmental impact of the projects so as to avoid greenwashing. A crucial aspect of this effort is ensuring private financing for climate transition efforts through globally comparable and transparent disclosure norms and taxonomy of green activities. The International Sustainability Standards Board, that is the ISSB, is actively working on all these aspects. While efforts are underway to improve and deepen green financing, it is equally critical to fortify regulatory frameworks that enable the implementation of climate taxonomy across jurisdictions, prevent greenwashing, and facilitate sufficient green capital flows to the emerging market and developing economies. A comprehensive and collaborative approach involving governments, private sector entities, financial institutions, civil society organizations, and the general public is essential for ensuring a successful transition to a sustainable future. Let me now conclude by saying that structural challenges such as financing global public goods, managing global debt vulnerabilities, and dealing with climate transition are uphill tasks which no country can achieve alone. Recommitting to multilateralism is the need of the hour, and this is precisely what the Indian presidency of G20 is trying to foster. It is also important to take note of the people-centric transformative changes taking place in G20 member countries, like for example, the UPI and the financial inclusion initiatives in India. Wider adoption of such models would make the world a better place for everyone and offer opportunities to everyone. I'll stop here. Thank you very much.
Let's now focus on how you see portfolios shaping up. If one by one you could share your picks which you would want to add in the portfolio at current levels, it would be wonderful, Mayuresh.
Absolutely. Morning, sir. So two aspects here. One, in terms of what we are looking at MarketSmith India, one of the stocks within the broader markets is Kirloskar Oil Engines. If you look and deep delve into this company, one of the largest producers in terms of generator sets across power outputs, so from 2 kVA to almost 1200 kVA. So it covers the entire power output that they can probably cater to. The second aspect obviously is numbers itself. Now, if you probably look at the top line for the quarter one, numbers just came in yesterday. 1,500 crores in terms of top line, much better than what the street expected, and much better in terms of both YoY and quarter-on-quarter performance. This has got replicated across to its bottom line. So I think EBITDA margins have expanded year-on-year, quarter-on-quarter on a standalone basis in excess of 12.5%. The bottom line growth has been substantial for the company in the quarter gone by, at 125 odd crores compared to what probably did last year, and even a better performance quarter-on-quarter as well. So the consolidated EPS has come to almost 9 odd rupees. They had done almost 24 rupees last year. So if you go on an annualized basis, looking at how Q1 is expected to how Q1 has performed, how the rest of the quarters might be. Q1 expected to be one of the weaker quarters and substantial performance year-on. So second half recovery can be extremely substantial. So my own sense is an EPS of 30 to 35 not ruled out. And therefore on MarketSmith, both the EPS RS rating looks extremely positive. Debt is very, very minimal onto its books. Whatever debt is there is related to the new financial services part that they're probably servicing at this point of time. And therefore, with a dividend yield of 1.25, this looks very, very attractive. So we're looking at an 18-20% upside. We do keep stop losses, as you know. So I think the stop loss is placed at 418,420 points. The other one that we like, Shelser, is Indigo Paints from the Paint.
Mayuresh, let's discuss KOEL first, and then we'll get to the next one. Sure. The stock already is at a record high that you see, but nothing much has happened on Kirloskar Oil Engines. If you look at the 10-year performance, is actually underperformed both the Sensex and the BSE Small Cap Index. It's just compounded at 11% over the last 10 years each year. So the stock might be at a record high, but remember, it's the infrastructure capex cycle that is kicking into the economy, and it is stocks like KOEL, when given a very nice tailwind of their earnings, are likely to outperform. Mayuresh, is my thinking right as far as KOEL is concerned? We haven't seen anything happening over the last decade as far as the stock price is concerned, but better days ahead.
Oh, absolutely. You're bang on the spot, and the entire logic probably just translates both in terms of their capacities that they have at this point of time, and the entire power chain is going through a huge amount of transition. Now, a lot of power stocks have probably moved across the chain. So whether they are generators, transformers players, whether they are transmission players, or even the EPC guys. To a certain extent, I think this is one of the backbones that is probably required for the entire power infrastructure as a space. And both domestic and export markets are holding extremely well. In fact, the best part, Shelter, about this stock is that with the new emission norms that are kicking in, the CPCB norms, as we call it, emission 4, this company is fully compliant across its value chain, where no other company in the Indian ecosystem is probably present at this.
And the interesting part, Mayuresh, just I was drilling through your MarketSmith India website at where you so ably head research. The 10-year PE, the average 10-year PE and the current PE of the stock is 17 and 19 respectively. So there is really no how should I say, exuberance in the stock, even if it is at a record high. So probably any dips here should make it all the more attractive. Coming to the price to book, 10-year median is 2, and at the moment the stock is at 2.9. Again, nothing out of the ordinary when it comes to roaring valuations that we see in some capex stocks as far as that particular sector is concerned. So Kirloskar Oil Engines, Mayuresh. Before we get to the next one, would you hazard a guess, given things remaining same, our defense is ceteris paribus as it is in economics, where would you see the stock 1 year from now?
I think the minimum target is the highest score that Lara has done, 501. So I think that's the minimum that you are probably looking at sales at just have a cricket correlation put in. I can't debate with you on economics, so I think I'll try to put my cricket dynamics in.
Okay, so 500 for what is better known as KOEL in the markets. Let's hope you listen to beautiful music on Kirloskar Oil Engines. Mayuresh, the next one, where do you see good color coming in?
Oh, absolutely. We do like indigo paints. Obviously, crude prices have moved over the last few weeks, but it is not a structural move as we see it. And therefore, I think the apprehensions that market has got that crude might move significantly from here, creating a dent in terms of input costs and therefore earnings for paint companies, is unwarranted at this juncture, really. Because paint companies have taken, to a large extent, price hikes. They might not roll back their price hikes if crude remains in the same fashion. And the expectations in terms of volume growth, Shelter, specifically in the second half, as festivities will start kicking in, is expected to be significant. For indigo in general, I think 27-28% in terms of volume growth compared to an Asian Paints at 8%, Hansa and Aerolac at 5%. The addition that probably happens in terms of their volume growth is the value-added products, which is almost 34%. So the cement paints, the ceramic paints that it has got, the wood surface paints that it has got, is something which is unique in the paint industry itself. And they have been growing at a humongous pace. The company is also stating that July, until we speak, has been extremely positive for the company. First half is normally very, very soft, but it has turned out that first half has turned out to be extremely strong for this company in general, and even better second half will mean volume stroke value growth will be significant going forward. Top line growth significantly higher, gross margins at 46-47%, the best in the industry. EBITDA margins at 17.5%, expected to remain stable or even improve going forward. Putting up a couple of plants, water-based and solvent-based, in the next few months, that should aid volume growth going forward. And not substantial amount of debt in their books makes it a very, very compelling case as far as indigo paints is.
If you like the video, do like, comment, share and subscribe.
We have with us Mr. Rahul Talele, who is the Group CEO at Kolte Patil Developers. Very good morning, sir. And thank you so much for taking the time out and joining us here on Business Today Television. I want to begin with the numbers only. First of all, congratulations, a good set of numbers. What really led to this and to this growth, and how do you plan to sustain this kind of growth going forward, and what's the outlook for FY24?
See, overall, the residential real estate industry is doing good, and there are various factors behind it. There is a strong accumulated savings for the upgrades of the properties. There is a strong desire to purchase the property. On top of that, these are the macro factors. The economy is doing good. The job security is there, particularly where we are currently operating. On top of that, consolidation story is also very strong. So affordability is still at the very optimum level for the real estate industry. And about Kolte Patil, see, we are taking care of the customer needs and customer aspirations. So we are understanding the market, dynamics, market intelligence, and based on that, we are offering a product and amenities which are the aspirational for the customers. On top of that, it is backed by a strong launch pipeline and strong launches that we could achieve in last few quarters. So based on that, we have delivered a good numbers, not only in terms of pre-sales, but on various other parameters as well. So our all-time high business development opportunities that we have concluded around 3,500 crores of GDV. So multiple approvals we have, sourced, multiple projects to the tune of 2,000 crores that we have launched. Sales consecutively more than 700 crores. Our net debt is all-time low. It is just a 17 crores, so which is 0.02 net debt to equity ratio. Revenue recognition is very good.
Right, Rahul. Absolutely. Rahulji, we'll discuss these in a bit. Let's focus on your stock price. Record high. These earnings have been very, very well appreciated by the market at about 464. You are trading at your highest level ever, and we've seen a very, very strong rally over the last 1 year, 61% up. Tell us what now from here on. Over the next 2 or 3 quarters, real estate companies are likely to face a lot of demand coming in. Interest rates may also go down. How many million square feet, how many 100,000 square feet are you planning to launch over the next 2 quarters, which is the second half?
So for this financial year, we are planning to launch around 7.5 million square feet, which is valuing around 5,200 crores. So out of that, we have already launched 3 million square feet. So balance around 4.5 to 5 million square feet is, lined up for the launches in this financial year itself. So this is if I compare a last 4 financial years, so this is the same volume that we are planning to launch in one single year. And based on that, like rightly mentioned by you, the RBI has taken a, stand of maintaining the interest rate, and we are hopeful for some betterment in that. So considering that and considering the upcoming festive season, because for real estate, generally Q3 is the strongest for most of the developers. So we are hoping for the positive numbers backed by strong launches. And on top of that, see, our premium products are moving good, and there are multiple launches lined up in the premium vertical for Kolte Patil. So based on that, we are confident of achieving this track record of 700 crore plus on quarter, and yearly, guidance of 2,800 crores of pre-sales number.
Absolutely. And sir, how is the demand scenario looking like at this point in time? Because experts have been saying that there is a bit of, a slowdown that is happening. So are there any signs of slowdown that you are seeing at this point in time?
I don't think so, because the way we are getting a response to our recently launched projects. So within the first month of launch itself, projects are either getting sold out, projects are either getting, 30, 40, 50% of velocities we are achieving. On top of that, there is a good amount of push for the better price realization within the launch itself. This is very new for the real estate and for us as well in recent times, but we are doing that. So based on that, I don't foresee there is any, demand reduction, particularly for MIG, spacious, and HIG or premium segments where we are concentrating currently.
Right. Rahul, if you can break your performance over the past quarter in terms of how much in terms of profit and top line Kolte Patil made from the luxury segment and how much came from the middle income, lower income group. The theme in the market is that luxury is fetching you more money and there is more demand for luxury than it is for the medium income. How have you fared in the last quarter?
Yeah. So see, in real estate, revenue recognition is linked to the occupation or the possession of the property. So whatever that we have sold around 2 years, 3 years back, that is getting delivered now, and revenue is getting recognized for those units. But what we are currently selling, for that revenue will recognize in the future. So let me answer from that perspective. So in last quarter, our pre-sales number, the products that we have sold, one third of the product were from the premium category and around 30 to 40% from the MIG spacious category. So 75% contribution is coming from a MIG spacious and a premium segment. In terms of value, also around 80% is getting contributed from these two verticals for us.
Right. Let's look at the stock performance again. And Tanya, this is an interesting data that I'll share with you. Over the last 10 years, Kolte Patil Developers has given a CAGR return of about 22.7% each year. Of course, it's at a record high, and it has just outperformed the realty index, outperformed the small cap index. So shareholders have had a good ride. Rahul, this is a question on the broader framework. Your face value is 10. And I see that the promoters own a 74% stake in the company from the very beginning of the IPO. Are there any plans to raise funds via QIP or any such format? What is your fund requirement for the next 2 quarters?
Generally funds are required for the business development opportunities or for the operation of the real estate. So from an operation perspective, we are confident that internal accruals are enough to address that requirement of construction, which is the largest cost in real estate. And particularly since we are launching multiple projects, we are getting a good traction during the launches. Most of our projects are at RCC stage and getting a good volume. So our free cash flows are going to be significant. So through free cash flow, we are confident to address our business development requirement. So in this financial year, we have already concluded 3,500 crores of GDV worth projects, and going forward, we are confident of closing around 7,000 crores worth GDV projects. For that, in cumulative, we need a cash flow requirement of 500 to 700 crores. So most of that will be sourced through internal accruals. On top of that, there is a good amount of room for the debt. Our net debt to equity just 0.02, and board has given an approval to go up to 0.5. So there is a delta of around 400 to 500, but we'll be very cautious, we'll be very judicious while raising any amount of debt. So we are confident of raising most of our BD requirements through our internal accruals. And in terms of a QIP, at a right time, QIP money will be utilized for any business development opportunities. At this moment of time, we are confident of addressing our super growth opportunities through internal accruals and debt.
Absolutely. Last question, sir. So the company mentioned that in the current financial year, it has acquired projects with top line potential of around 3,450 odd crore rupees. So if you could tell us about that, and if you could quantify that order pipeline number for us as well.
Yes, so we have acquired around 6 projects. Out of that, 4 projects are from Mumbai, which are the GDV of that is around 2,200 crores. And the rest are from 2 projects are from Pune. So one more interesting thing. So currently we are around 80% of our value is coming from Pune and 20% is coming from non-Pune. So we are aiming to diversify by another 10% by FY25. So from that perspective, we are giving a push to our Mumbai BD opportunities so that these projects can be launched in the next financial year.
Okay, absolutely. And on that wonderful note, all the very best for the coming quarters as well. And thank you so much for being with us here on Business Today Television.
If you like the video, do like, comment, share and subscribe.
I want to turn to the point about acquisitions that you said right up front. What is the plan there? Again, commentary suggests that you have you're looking to acquire 3 to 4 companies in the digital space and kind of just add it up with the $1 billion target that you have. So, what's the strategy going to be there, and what specific actions?
So, $1 billion aspiration target to reach that number by 2031. That requires us to do a CAGR growth of about 25%. And our this year's guidance on revenue growth was also 25%. If you step back, the 25% number growth that we had given for this year is both organic and inorganic put together. So inorganic has a very key role to play in your growth model as well. Now, coming to acquisitions, we would like to do the 3 acquisitions, but these are all binary in nature. We have got a good pipeline of companies that we are already in discussion with. We would have wanted to close at least 1 or 2 of them earlier than later. But with the way things have progressed, because this is not just about valuations, it's about you need to structure, you need to align their business, you need to get agreement from the people on the other side, because it's finally a people to people, it's a people business at the end of the day. And there is a huge amount of work that needs to be done on alignment, whether it is culture. You can't change culture, but you at least need to make sure that you don't step on each other's feet. You need to give them space and all of that. So those are the things which are taking a little bit of time to, sort out along with the valuations. And we hope to do at least 1 or 2 during the course of this year.
I could obviously not the names, but could you hint towards the nature of the companies that you are targeting at looking at? Apples, oranges, or strawberries?
Oh, yeah. We are looking at 100% digital company because we are about 96% digital. So the best place would be to, look at adding to capabilities and competencies with companies who are 100% digital. The size of the companies that we are having in our pipeline or in our long list range from 10 million to 45 million plus. Profitable companies, because I don't think we would want to buy into a company or partner with a company and then get into turnaround, because that will be too much of effort. So we are looking for profitable companies which will take us into certain verticals of our choice, strengthen key verticals like healthcare. The last acquisition that we did in December strengthened our capabilities significantly in healthcare segment. Also took us to tier 2 market like Madurai and Coimbatore. So these are the aspects that we look for. Digital companies which are into product engineering, or they can help us add, capabilities into certain competencies or verticals.
Is this where you will deploy partly or fully the recent cash raise? What's the plan for the money that you raised?
So we today have cash resources or cash balance of about 1,200 crores, and we are adding to that every year through our own cash generation, close to 200 crores. The QIP that we raised, that's what you are referring to, was about 500 crores. And
Right.
That was partly to fund our organic and inorganic growth needs. So, fungible cash, we'll have to replace one with another and make sure that we meet our capital structure appropriately. But like you rightly said, a large part of that will go to funding our strategic initiatives.
Yeah, so despite all the push towards digital, and digital is great, cashless payments, cashless economy, cash on the balance sheet of a company is always the best. Cash is king when it comes to balance sheets, and investors are always very happy to note that. Of course, in certain cases, some investors would like for more aggressive utilization of the cash and not just treasury income.
If you like the video, do like, comment, share and subscribe.
Hello and welcome to Business Today Television. I'm Siddharth Zarabi, and joining me now is Venkatraman Narayanan, the Managing Director and CFO of Happiest Minds Technologies. Welcome to the show, Venkat. A good set of numbers that you have shown. What are the key financial indicators that you would like to share with our audience at the start of this conversation?
Good morning, Siddharth, and thanks for having us on the show. Uh, if you look at our numbers, we have really posted decent, I would say, better than what the industry has shown in terms of revenue growth, profitability, including what we are seeing as possibilities for the year ahead or the quarters ahead. Revenue has grown, total income has grown about 4.7% QOQ. Operating income in dollars has grown about 3.6% and about 13+% year over year. So all of this indicates the strength that we have in our internal systems to get the revenues from our customers and continue the growth path that we have set for ourselves. Coming to the bottom line, we have been talking about a guidance of 22 to 24% on EBITDA. 13th quarter in a trot, we have beaten that guidance and we have beaten 25%. So we've closed this quarter with 25.5%, Siddharth. So all round good performance. First quarter where we crossed 100 crores of free cash flows, 100 crores of EBITDA, including EBITDA. We've crossed 5,000 people, happiest minds as we call them. So the family has become 5,000 people. We are now looking to see how to engage more and expand through acquisitions.
Okay, that's a good point. Before I come to the acquisition part, just a quick note. I'm sure shareholders, investors would like to know how long do you think and how optimistic are you really about maintaining the 25% odd margins going forward?
If you look at my guidance, I've always guided between 22 to 24%, So we have taken into account some of the inherent risks in the business, which is, some bit of seasonality, cyclical nature of business within the 4 quarters of the year, because you have typical Q2 for the IT industry has got a lot of cost increases in terms of wage increases. That happens. And then there is always the risk of foreign currency. That happens because 72% of my business comes from overseas. And to overlay all of this, there is this talk and fear of whether there will be a pushback from customers on rates and rate reduction. So these are all things that we keep on the top of our mind when I do my forecasting. With that is what we have come up with, this number of 22 to 24%. And we are quite confident of retaining that number for at least some time, medium term at least.
Okay, medium term. What would be the medium term outlook description? Would you call it uncertain, or would you say that some of the worst uncertainty and fears are behind us now, and the industry will have to wait it out for maybe till the end of the current calendar year?
So here I would go with option 2, because we were all waiting for that so-called recession to happen in the US, which obviously doesn't seem to be happening. And my guess is as good as yours or any other economist is what I would like to say. But as an industry, we are all looking for a better second half. That's one. And within the industry, there are pockets where growth is happening. So the companies like ourselves, we are growing, maybe not at a blistering pace, but on a comparative basis, growing 3.7% on a sequential basis and continuing to aspire for the 25% growth through organic and inorganic means does set us apart. But how long will that happen is the question that most of the people have. But largely, I think the second half should look better. And for sure, next year, obviously, it has to be. Because whenever there is a turnaround in the so-called economy, the IT industry has been the first to come out of it. And they come out rather strong. You saw it pre-COVID, post-COVID. You saw it after the banking and financial crisis. And even before that, Y2K. And there are many instances where we have proved this multiple and many times over.
Absolutely. And briefly on a macro basis, you are absolutely right about the recession that hopefully will never happen. but there's another event that some people had foreseen, but a vast majority never imagined, which is deflation in China, the world's manufacturing powerhouse. But we'll leave that for later. What I want to understand is where will this growth come from? What kind of specific verticals? And if you could also provide a geographical outlook for the growth estimates that you are pointing towards.
About 72% of our business comes from the US, 15.5% from India. Europe is about 9%, and the rest comes from the rest of the world. Rest of the world includes Middle East, Australia, which is showing decent and good traction. India, it's a good bright spot, brown spot, whichever way you want to call it, in the global economic landscape right now. So that's doing pretty well for us. And I should also say that the business that we do in India is not at suboptimal rates, as many people would call it. We do it at really competitive prices, and people really want good services. That's what we are seeing. And obviously the US, which calls out 72% for me. Obviously, growth has to come from there, and we are seeing that growth happening within the verticals of our choice. With respect to verticals, EduTech continues to do well. From this quarter onwards, we have started calling out healthcare as a separate segment, and as you will see, that's about 12.5%. So there is distinct growth happening there. Media and entertainment, where we work with certain large US corporations, is doing well, but obviously there is a little bit of wait, think, and do the next kind of an approach there. The retail CPG vertical is also in such a mode where they are saying let's hold on for a while, but we are seeing growth and in fact new signups happening in that vertical. So if you look at it, all verticals doing reasonably well, but within the verticals of our choice, it's EduTech, healthcare, and manufacturing are the three which are doing particularly well for us.
How does the deal pipeline look like?
Deal pipeline is looking good. In fact, 17 new logos is what we signed up last quarter, 18 logos this quarter. So total takes it up to 35%. And if you look at how these logos are performing, they are adding to the revenue that we are accruing right now. A good metric for you to figure that out is the repeat business. Repeat business typically tends to be about 91-92% for us. This quarter, we have shown repeat business at 86%, which means the 14% is coming from the new and the new logos that we have signed up. Two of the logos that we have signed up are billion-dollar corporations. So today we have got 55 plus 2, $57 billion corporations in our roster of customers. And these are the customers who will help us, address the growth aspirations that we have.
Okay. You spoke about the EduTech sector, and you have a fairly decent exposure to that. Around 23% of revenues come from that. What is the outlook for the EduTech sector? Because there is some commentary that it's likely to be impacted by generative AI, and there might also be a slowdown that some companies are facing, at least in the Indian market.
So there are two things. One is almost all of our business on the EduTech segment comes from the US. We count about one large customer in India. And this is also not one of the new age EduTech companies that I would like to. It's a very old educational institution with whom we are working very closely on building a platform for them. So one is the fear of comparing it with what's happening in the Indian EduTech segment. I would like to defray that. The second part is coming to the generative AI. We are seeing that as an opportunity, in fact, because when you have a new technology like this coming out, you typically tend to have use cases, POCs, and then you need to look for customers. Thankfully, we have got this segment, EduTech, which is taking it on their chin, and they are wanting to embrace this technology ahead of time. So to that extent, it gives us that much, runway to sell into them with this new age technology. Now, generative AI and ChatGPT, these are things. Setting up a core team which will take this into existing customers and new customers. And there is a lot of investment in terms of time and effort that will go into setting this up. And when you do that, you need to have use cases and customer case studies. And what better place to start other than EduTech?
What is the demand outlook for high-end product engineering work? And again, you derive significant amount of revenues from that particular segment.
About 50% of our business comes from product engineering, and we are seeing good demand in that segment, Siddharth. So there is, I would not say no concern, but I would say that's not having growth is not the concern there. So we are seeing quite a bit of signups. In fact, almost all the 50% of the signups that we saw, 17 plus 18, are within the PES segment. In fact, most of the people want to go SaaS. They want to get into platformization of their business, get into non-linear business models, customer outreach models, and all of that finally finds itself into the platform engineering type of business.
Okay, I want to turn to the point about acquisitions that you said right up front. What is the plan there? Again, commentary suggests that you have you're looking to acquire 3 to 4 companies in the digital space and kind of just add it up with the $1 billion target that you have. So what's the strategy going to be there, and what specific actions?
So $1 billion aspiration target to reach that number by 2031. That requires us to do a CAGR growth of about 25%. And our this year's guidance on revenue growth was also 25%. If you step back, the 25% number growth that we had given for this year is both organic and inorganic put together. So inorganic has a very key role to play in your growth model as well. Now, coming to acquisitions, we would like to do the 3 acquisitions, but these are all binary in nature. We have got a good pipeline of companies that we are already in discussion with. We would have wanted to close at least 1 or 2 of them earlier than later. But with the way things have progressed, because this is not just about valuations, it's about you need to structure, you need to align their business, you need to get agreement from the people on the other side, because it's finally a people to people, it's a people business at the end of the day. And there is a huge amount of work that needs to be done on alignment, whether it is culture. You can't change culture, but you at least need to make sure that you don't step on each other's feet. You need to give them space and all of that. So those are the things which are taking a little bit of time to, sort out along with the valuations. And we hope to do at least 1 or 2 during the course of this year.
I could obviously not the names, but could you hint towards the nature of the companies that you are targeting at, looking at apples, oranges, or strawberries?
Oh, yeah. We are looking at 100% digital company because we are about 96% digital. So the best place would be to, look at adding to capabilities and competencies with companies who are 100% digital. The size of the companies that we are having in our pipeline or in our long list range from 10 million to 45 million plus. Profitable companies, because I don't think we would want to buy into a company or partner with a company and then get into turnaround, because that will be too much of effort. So we are looking for profitable companies which will take us into certain verticals of our choice, strengthen key verticals like healthcare. The last acquisition that we did in December strengthened our capabilities significantly in healthcare segment. Also took us to tier 2 market like Madurai and Coimbatore. So these are the aspects that we look for. Digital companies which are into product engineering, or they can help us add, capabilities into certain competencies or verticals.
Is this where you will deploy partly or fully the recent cash raise? What's the plan for the money that you raised?
So we today have cash resources or cash balance of about 1,200 crores, and we are adding to that every year through our own cash generation, close to 200 crores. The QIP that we raised, that's what you are referring to, was about 500 crores. And right. That was partly to fund our organic and inorganic growth needs. So, fungible cash, we'll have to replace one with another and make sure that we meet our capital structure appropriately. But like you rightly said, a large part of that will go to funding our strategic initiatives.
Yeah, so despite all the push towards digital, and digital is great, cashless payments, cashless economy, cash on the balance sheet of a company is always the best. Cash is king when it comes to balance sheets, and investors are always very happy to note that. Of course, in certain cases, some investors would like for more aggressive utilization of the cash and not just treasury income. One last question, and this is something that I've been asking practically in every quarterly earnings review with IT companies. And this is the talent mix. A lot of engineers coming out of our institutes every year. There's been a bit of a hit due to the downturn in the startup space. To a young boy or a girl looking for a career in a company like yours, what would you say? What kind of skill sets are you out there looking for to hire youngsters from?
I would start with attitude, Siddharth. So that's what really matters, because learnability and attitude is what really differentiates you. If you look at it, if you say what skill somebody comes up with, you would typically only look for computer science, right? But if you look at the hiring pattern, we look at people who come from other streams, just not computer science, and who show high learnability index, who score high on the learnability index, flexible, understand business. Because today, every technology person requires to understand business, then deploy technology on top of it. So the business analyst role that everybody gets to play will really make the difference. So understand business, come with an understanding of the business or thirst to understand business, and then apply technology. That's a skill I would say everybody should come up with.
And the latest
attitude.
And the latest buzzword around AI and LLMs. What would you say to job aspirants who are looking at such buzzwords?
Pick up the skill. So earlier it used to be analytics, and it was automation, it was blockchain. So these are things that you need to pick up as you go. So many a time, this is my personal remark, you have to unlearn quite a bit of what you learned in college before you can get onto the work. So, there are fancy words like on-the-job training, finishing schools, but all of that point towards, that ability to learn and absorb new technology and how to apply that to business circumstances. That's what it's all about, Siddharth. So attitude, learnability, and the ability to apply the new skill that you learn to business and business context, put a business context around it. And I think you have a winner.
And if I add one more word to that, and I'll say all the attributes that you have outlined here equal to a happy mind working in a happy, successful, profitable company. Venkat, thank you very much for your time with us today. I enjoyed this conversation and hope you did too. Viewers, that was Happiest Minds Technologies taking us through their quarterly review and obviously some forecasts as well. Thank you very much for viewing. We will be back with more. Till then, goodbye.
If you like the video, do like, comment, share and subscribe.
Welcome our guest on the show today and find out more about the policy. So we have with us G. Chokalingam. He is the founder and MD at Economics Research, and we also have with us Mr. Amit Somani. He is the senior fund manager at Tata Asset Management. Shell is also now with us. Shell, first of all, coming to you, what do you make of this policy, and what's really not working for the street as we are seeing deep cuts?
So the two things, Tanya, that are not working for the market are incremental CRR deposits of 10%, to mop up excessive liquidity, which the central bank governor has put in. That's a very, very big negative seen by the market. especially on banks. And the top losers are the Nifty Bank, the Nifty PSU banking sector index, the Nifty Private Bank index. These are the top 3 losers. And of course, the raising of the inflation target from 5.1 to 5.4%. So these two things, and the fact that the governor has repeatedly said that the focus remains in aligning inflation to what we have said earlier, which is 4%. So these two things are what are bothering the market in the short term. But we have Mr. Chokalingam who's seen the market much more than I have. Let's go to him directly. What do you think, sir, are the other things that caught your attention in Dr. Shaktikanta Das's statement?
Frankly speaking, nothing has caught my eyes in a significant manner. Because all are in expected way. The status quo, most parameters, the status quo is maintained. These are all in expected way. So there are two important perspectives I want to present, to understand monetary policy and markets. The one, starting from 2014, the repo rate, benchmark interest rate has come down from 8% to 4% in May 2020. So we had a stability of economy during this process, and then we had a major hit in terms of COVID, which was deflationary. So it came down to 4%. So almost a 400 basis point cut happened. Then the second phase, starting from May 2020 to February 23, the rate has gone up to 6.5%. So 250 basis point rebound happened. But this rebound happened because the inflation went out of control. So now we are at 6.5%. Are we going back to 8% or are we going back to 4%? That is a question. Certainly, in the light of today's policy announcement also, I can make a very bold statement that we are certain to be in the mid-range of around 6.5% or 6%, at least for another 3 to 6 months. And it is possible that this rate can come down to even 5.5% in the next 6 months to 12 months. So that is the forecast, because a lot of good things are happening on the inflation front. We all know that WPI inflation is negative, and the CPI inflation also has come down a lot. Now there are only two problems for the inflation and markets. One is the rising oil price. If you see, oil price used to be as low as 47% on year-on-year basis 5-6 months back. Now world oil price is down just 8% on year-on-year basis, because Saudi Arabia has cut the oil output, so it's going up. This is the area of concern. And then vegetable rice, wheat prices rise in the Indian economy. But if you want to decompose the inflationary impact, there are two factors. One, short-term disruption, like tomato, onion prices, vegetable, fruits prices, they shoot up. That I won't call it as a structural change. That is because of supply-demand gap in the very short term. I would call it as a disruption. Second, the inflation rate jumps or falls because of the structural change. They are down by the global factors and domestic factors in a big way related to GDP and oil prices. So structural factors are conducive for India's inflation to fall further, because China yesterday they announced certain numbers which show sign of deflation. European economy almost stagnant. US economy has come down, and US oil output is at a record high level. So therefore, the oil price is unlikely to shoot up further, and the slowdown in the growth is also likely to moderate the metal prices. Only copper price has gone up. Still, all other metal prices are quite low. So therefore, India is in a best position, to ride on, contain the inflation rate. And RBI, to be very straightforward, I think it has no role to play in the stock market for next 6 months, because they have to maintain this mid path of around 6%, 6.5% for at least 6 months. Then they will start cutting down. So there is no worry for the market at all. And the market is falling because your market cap is around 300.
It's down.
It's down because of profit booking. The overall market cap has hit 300. Profit booking. The overall market cap has hit 300. On the growth, one is the banking, obviously topmost sector, which is 16% credit growth. and followed by automobile sector, and then to some extent the telecom.
Okay,
So
absolutely.
many sectors are growing in single digit, valuation comfort is not there. So that is the reason for correction in the market. I do believe another 2-3% correction can happen in the stock market in the short term.
Sure. And what are your thoughts on the rate trajectory from here, Mr. Chokalingam?
Yeah, the rate would remain at 6.5 at least for another 1 or 2 months, or 2 even 3 months. After that, it will definitely fall because the world economy is not going to pick up in a big manner. Oil price is not going to hit triple digit because of the signs of deflationary condition in China and near stagnation in European growth and slowdown in the US economy. Even in India, if you see in July, our oil import has come down to 8-month low. So there are a lot of signs of worldwide correction in the growth. So therefore, oil is also going to be comfortable. And most importantly, and the disruption factors which I mentioned, vegetable, rice, wheat, fruit prices. Very interesting data point. As of yesterday, the rainfall has improved. Today, the rainfall, cumulative rainfall used to be deficit in double digit. Now it is exactly equivalent to the long period average, the cumulative rainfall. There is no deviation. It's an absolutely normal. And second, if you see the spatial distribution, that was also concerned till 2 weeks back. Now 72% of 36 subdivisions have received a normal or excess rainfall. Even the Kharif area has improved to last year level. So this is only a temporary phenomenon. The vegetable, fruits, and rice, wheat prices. Within 1 or 2 months, all this would start coming down once you really get the Kharif crop number followed by winter crop number.
Okay, absolutely. Let me now, get in. Let me now ask Amit Somani, Mr. Amit Somani. Mr. Somani, what about you? What do you make of the decision, and which sectors, according to you, will be in focus after the policy, and what really didn't work? I think the incremental CRR thing, that is something that the markets are not really liking at this point in time.
Thank you. So I will give this more from a fixed income perspective rather than broad market. But yes, so ICRR is something that market was not expecting, and they gave, I think, back of the envelope calculation seems that it will increase the CRR by about 3 to 5% of what currently banks are required to maintain with RBI. This applies only on NDTLs post 2019, and this comes into effect on 12th of August, and it gets reversed on 8th of September, as mentioned by RBI. So one, I think banking system, will have to show that additional amount, 3 to 5% in terms of parking with RBI. That will have some impact on whatever the NIMs, if I were to put it that way. But I think beyond that, RBI is also very mindful that one, there was a flush of liquidity in a banking system, given post 2,000 rupees callback into the banking system. And July and August are typical months seasonally, shows the currency circulation going back into the banking system, which means that RBI utilized this window, July and August window, to hike this IC through ICRR, and trying to address it, and then look beyond once the reversal starts happening, as also mentioned by Mr. Governor, that the festive seasons, and I think they are very clear that they always want to maintain a liquidity to the extent that doesn't hamper any credit growth. It seems, there is a broad number.
Right, Mr. Somani. Let's look at the markets for a while. There has been a drastic fall in both the Nifty and the Bank Nifty. Of course, as you rightly mentioned, it's the incremental additional CRR that's come into the banking space. We've seen a mild green tick at 19,530, but unlikely to be held. Mr. Somani, the governor has gone at lengths to describe the wonderful situation that India's macro and micro picture are in. Given the fact that we've corrected, quite okay from the recent top that we've seen on the Nifty and the Bank Nifty, as a fund manager, given the second half is in front of us, what are the sectors that look good to you for you to put in good money?
I'm sorry, I don't want to get into the sector discussion right now. And this thing, I will leave it to other guests for that.
Okay. Mr. Chokalingam, what are the sectors that look attractive to you at present levels?
Certainly, the banking sector, as I mentioned, the interest rate cycle has peaked out. It's going to fall maybe after 2-3 months. The chances are very high. And second, as I mentioned, the rainfall has improved. Kharif area under Kharif crop also has improved. So that is also going to be positive in terms of containing the inflation rate. Other directly, the tailwinds are also there for the banking sector. The credit growth is now above 16%, which is a 10-year record high. The quality of asset of the banking sector is also at the 10-year record high level. So therefore, yes, there could be some profit booking volatility, but ultimately in the short to medium term, the banking sector would do extremely well. And followed by automobile sector, particularly stocks like Maruti. Personally, we don't have, but we have a buy call on Maruti. And general auto sector will do among the sectors. And third, the telecom, because non-tax revenues of the governments are coming down after exhausting the cash pile of the PSUs. So the one area where the non-tax revenues can be increased is allowing the telecom companies to consistently in a small way to increase the tariff for the public, and that's already visible. So that would be positive for mobile operators. These are the three sectors which would do very well. But otherwise, from a defensive perspective, one can consider FMCG. But if you ask me what can grow faster among all the major sectors, these are the three sectors which can grow much faster.
Right. Choka, Mr. Chokalingam, let's take this discussion a bit forward. You are a very good stock picker when it comes to mid caps and small caps, especially in the banks. What would you prefer?
A little late, to be honest, because the banks have run up. But still, if there is any decline, one can buy Bank of Maharashtra. Bank of Maharashtra looks to me like a mini HDFC Bank. It should not be misinterpreted as comparison of the stock prices. I would not say that it will go to 3-digit, but if you see the parameters, whether it is a credit growth, CASA ratio, net NPA, provision coverage, excellent. I mean, and apart from that, in Q1 FY24 itself, the bank started making provision for ECL, expected credit loss provision, which is going to be implemented from the current year. So that is a one stock for medium to long term. Amazing stock. Net NPA is just 0.25 or 0.24, which is the lowest in the industry. And second in the large cap, definitely HDFC Bank. But for long-term wealth creation, I'm extremely bullish on Bank of Maharashtra.
Okay, Mr. Chokalingam, and one quick word on the way, global macro indicators have also shot up, be it dollar index, yields have surged a lot. There's also a talk of some of the US banks into trouble. That is, I'm talking about Moody's commentary. So could that also cast some amount of shadow on our macros as well?
They will give opportunity in the stock market. Unfortunately, I'm sorry to sound a little overconfident. This is what I maintained 2007, 8, 9 Lehman crisis also. The US economy was shaking, but our markets fell 22%. And foreign investors ran away from India. So I was comparing with, when you have a tremor or earthquake, when buildings are shaking, you try to move to the stronger building, but they went back to shaking building, leaving a strong building, India. So similar things are keep happening now and then. But I must tell you that the Indian banks have nothing to do with US banks to a large extent. More than 90% of the lending happens within India. More than 90% of the resource mobilization by the banks happen within India. So we are least linked fundamentally or in terms of economic parameters. But certainly perception in the short term plays more role than the economic reasons. So it can give opportunity. Even if you look at the US economy, they are talking of $1 trillion of outstanding credit card by US citizens. So then they are talking about $1 trillion interest payment by US government every year. So therefore, India's story looks amazing. Yes, right now valuations are stretched. Right now there are three short-term risks: November, December election results, and Rajasthan, Madhya Pradesh, and then May 24 general election. If we can
Okay.
pass three short-term risks, I I would like to say that India is set for a amazing wealth creation story for another 5 years, only subject to any possible war from North Korea or in Taiwan. Otherwise, India's story is going to be excellent. Let us recall what S&P also said. For
Okay.
next 7-8 years, our average growth will be about 6%. So that will be the
Okay.
fastest growth in the world.
Absolutely, Mr. Chokalingam. Lastly, any picks that you have from railway pack or defense pack, these sector have been buzzing off late, and any picks that you have from power sector as well?
Yes. Power sector, we have a buy call on Tata Power. Personally, I do not own it. I would say I have pitched this as a great futuristic stock. The Tata management, I don't have to work for it. What is interesting is that they have been saying that the renewable energy would become 80% of the total power produced by Tata Power, and they have been working on it in a very successful manner already. Already they delivered credible increase in the share of renewable energy in the total power, and they are also doing very well in rooftop solar. So this is a one stop, not for short term, medium to long term. I think this is going to be a ESG stock, and it's going to be a stock which will be liked by a lot of foreign investors in the next 1 to 3 years. And I would advise continuously, some caution for the retail investors on, railway stocks and different stocks. So let us not forget the fact that whenever there is a bull market in the small cap space, these two jump like anything. So you have to be very early entrant to make money. Otherwise, you will have to wait for another 3 years to get back your principal. So I do not see the valuation comfort in any of those. One can consider, Indoco remedies. I personally again do not have. This is our official buy recommendation. I've been successful, in giving a recommendation in the past on JB Chemical and Unicom. So after that, I was breaking my mind what could be the next one. Of course, it cannot give you reward like a JB Chemical. That was outstanding, but I definitely
Okay,
feel
absolutely.
Indoco Remedy can give excellent return because it trades at 3 times, domestic branded sales and 1 time export
Sure.
sales. So many branded sales companies are trading at even 7-8 times to sales, enterprise value to sales. So
Okay.
I feel it can create a lot of wealth in the medium to long term.
Okay, absolutely. Got that, Mr. Chokalingam. But Mr. Somani, coming to you now, what are your thoughts on the rate trajectory from here on?
Sure. So I think policy is broadly in line with what market was anticipating. The ICRR that we mentioned, so I think that will have some impact on the short-term rates for at least next 1 month. The 10-year currently continues to actually hover around the same range. It was a little higher, which only, kind of reconfirms that the entire policy was in line. In fact, the market feels confident that RBI has laid emphasis of on the spike in inflation. Do they remain confident that vegetable prices will reverse? I think they are at the same time they have mentioned that they will continue to act if necessary, which gives confidence to the market that RBI continues to hold Arjun eye on inflation number. So while the near-term trajectory seems to be on a higher side, with the kind of revision that we are seeing, probably this month's inflation seems upward of 6.5. The number will remain there for next couple of months. But I think beyond that, RBI the markets are also much confident that RBI has kept its eye, and thus we see that the 10-year continue to range between 7.5 to 7 quarter levels or so. Upper end remains a good time. It throws a good opportunity for someone who wants to tap into. The short-term rates are likely to see some increase, and I think most of the correction should get done by today end of day or tomorrow at max. This measure that they have taken is likely to reverse on 8th of September. So it will be a little kind of a short-term pain in a very, very short term.
Okay, absolutely got that. And on that note, thank you so much, gentlemen. Thank you, Mr. Chokalingam. Thank you, Mr. Samani and Shell, for being with us here on Business Today Television and for sharing these valuable insights.
If you like the video, do like, comment, share and subscribe.
The next announcement, actually there are 3 announcements within this announcement, and it relates to UPI. And basically the announcements are related to bringing in conversational payments and offline capacity on the UPI, enhancement in transaction limit of small value offline digital payments. The details are as follows. With the objective of harnessing new technologies for enhancing the digital payments experience for users, it is proposed to, number 1, enable conversational payments on UPI, which will enable the users to engage in conversation with artificial intelligence powered systems to make payments. Number 2, introduce offline payments on UPI using near field communication technology through UPI Lite on device wallet. And number 3, enhance the transaction limit for small value digital payments in offline mode from rupees 200 to rupees 500 within the overall limit of rupees 2000 per payment instrument. These initiatives will further deepen the reach and use of digital payments in the country.
If you like the video, do like, comment, share and subscribe.
After detailed deliberation on all relevant aspects, the Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6%, 6.5%. It's 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate stand at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me now explain the MPC's rationale for these decisions on the policy rate and the stance. Headline inflation, after reaching a low of 4.3% in May 2023, rose in June and is expected to surge during July-August, led by vegetable prices. While the vegetable price shock may reverse quickly, possible El Nino weather conditions along with global food prices need to be watched closely against the backdrop of a skewed southwest monsoon so far. These developments warrant a heightened vigil on the evolving inflation trajectory. The cumulative rate hike of 250 basis points undertaken by the MPC so far is working its way into the economy. Nevertheless, domestic economic activity is holding up well and is likely to retain its momentum despite weak external demand. Considering this confluence of factors, the MPC decided to remain watchful and evaluate the emerging situation. Consequently, the MPC decided to keep the policy repo rate unchanged at 6.5%.
If you like the video, do like, comment, share and subscribe.
Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. The Reserve Bank of India earlier today warned of a surge in inflation in July and the current month of August due to costlier vegetables, and as a consequence has revised upwards its inflation estimate for the year by as much as 30 basis points. Thankfully, the central bank has not raised interest rates. It has kept the repo rate at pause and it has indicated that it will remain focused on the withdrawal of accommodation and is ready to act if required. The RBI Governor Shaktikanta Das in his statement today also acknowledged the role of tomatoes in the current inflation surge. Let us first listen into what he had to say, some of the key highlights.
Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6%, 6.5%. It's 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate stand at 6.75%. Headline inflation, after reaching a low of 4.3% in May 2023, rose in June and is expected to surge during July-August, led by vegetable prices. While the vegetable price shock may reverse quickly, possible El Nino weather conditions along with global food prices need to be watched closely, with the objective of harnessing new technologies for enhancing the digital payments experience for users. It is proposed to, number one, enable conversational payments on UPI, which will enable the users to engage in conversation with artificial intelligence powered systems to make payments.
Well, that was the RBI Governor, and joining me now to discuss and decode what the RBI has really done and what it means going forward for interest rates and broader indications for the economy. Hello and welcome to Business Today Television. I am Siddharth Zarabi and you're watching Easynomics. On the show today, we discuss China's deflation. Yes, you heard that right. China is deflating. And the questions that we ask, the big one really is whether India can benefit from the ongoing downturn in the world's second largest economy. Beijing's troubles have increased due to the unprecedented move by President Joe Biden virtually just a day ago, who has announced a long-expected executive order that curbs fresh US technology investment in China. Viewers, this is the first time that the United States is imposing a restriction on American capital flowing out of the country. Hasn't happened, and at least not in this manner ever before. And more such measures could be in store where America targets China. This is a clear signal that China is no longer a clear-cut option for American capital, and the favor seems to be over of some decades ago. And joining me to decode the bad news for Beijing and its troubles are Professor Shrikant Kondapalli, Dean of the School of International Studies, and Robinder Sachdev, President, Image India Institute. Thank you very much for joining us today. Professor Kondapalli, I come to you first, sir, to put this in context. COVID emanating from China, at least there's no debate about that, and a situation where the whole world suffered economically, but much of the world has come out of the worst of the economic issues that started with COVID. But China seems to be slipping and slipping continuously. What is really going on in China? Go ahead, Professor Kondapalli.
Thank you for having me in this show. I think there is a substantial decline in GDP growth rate over a period of time. In the 1990s, China grew around 12%, and in 1 year at 14%. And that declined to about 10% annual growth rate in 2010, and now last year to 3.3% growth rate. This year, it is expected by the premier, initially Li Keqiang and now Li Qiang, they mentioned about 5.5% growth rate for 2023. However, the PMI manufacturing index is relatively low, below 50 points, where the problem of economic growth rates become very acute. So the GDP decline is the most important one, because since the reform began, China had been articulating about GDP growth rate, sometimes at the cost of the social sector. So key problem here is the GDP. As the Tiananmen Square incident indicated, the Chinese Communist Party made a deal with the people on economic growth rates. That is number one. Economic growth rate decline meant there is also problems that you have just mentioned, the deflationary pressures and so on. But in terms of the social sector, the Chinese Academy of Social Sciences once made a survey and concluded that for every 1% decline in growth rate, there are 8 million unemployed or the layoffs. One of the effects of deflation is also the labor layoffs, workers' layoffs, creating unemployment. So today, various estimates are made on unemployment. It is argued that it is about 21% unemployment, youth unemployment in China today. And some Chinese economists say this figure can go up to actually 44% of the unemployment. So that is the bad news, because the social sector is the worst that has been affected with, as you mentioned, the COVID-19 related lockdowns and others, which created this spiral. The long-term effect of this is how China can get out of the middle income trap. As you know, there are over 116 countries which have not been able to pass through the middle income trap. China today has about $11,000 per capita. And if they do not increase the per capita as a result of the economic growth rate decline, it is easier for China to go through this middle income trap. So that is a long-term problem, in addition, of course, to the unemployment, the layoffs, and the growth rates decline, and so on. Siddharth?
In fact, viewers, let me also take you through some of these other numbers and this rather unprecedented statement by a US president saying that China is a ticking time bomb. You know, it's not just reflective of geopolitical tensions and the rivalry between the world's largest economy and the second largest 15 trillion odd dollars economy. And like the professor just said, weak growth, but let's take a look at some of these numbers once again, and let's bring up those charts. China GDP growth, look at the trend. If you look at the 5 quarters of data that we have here, the first quarter of FY23 minus 1.9%, the second quarter we saw 3.2%, 0.45% in the third, 2.2 in the fourth, and the first quarter we've seen a sharp decline. Now you look at consumer prices. If we move to the next one, the CPI trend in China, March, April, May, June, July 5-month data. Again, this 5-month data will show you what's happening. In fact, July has been a slight uptick, but 4 consecutive months, and this data is captured on an annual basis. So that also tells you something. Again, a quick look through once at the export numbers. The export and the manufacturing powerhouse of the global economy, China, and a journey that began well over 3 decades ago now seems to be sputtering. It's not to say that we can write off China so easily and so fast despite everything, but look at that, look at the export data, and that shows you export decline is consistent, and between March and July it's a reverse flip. March had close to 15% exports, July has close to almost a 15% dip in exports. And youth unemployment, those numbers and the concern that Professor Kondapalli spoke about, the July numbers, viewers, are expected to be even higher than the record 21% that have been spoken about for the first quarter. And clearly, policymakers in China don't seem to have answers to this problem. Youth unemployment has doubled in the last 4 years. Ravinder Sachdev, I'm coming to you with that very same question. Put this entire basket of economic woes in context, and if you want to add something about the likely consequences in societal terms that this communist dictatorship nation with capitalist features that China really is. Ravinder Sachdev.
So, thank you so much, and honor to be with you and Professor Shrikant. See, in a few bullet ways, simplified, one could look at this way. China is right now in a deflation. Okay, it's temporary, maybe. How long it goes, we don't know. But remember the deflation of Japan in the 90s, which led entire decade as a lost decade to Japan. China is not there yet, but there are those parallels being talked about into the future. But what does deflation mean? Deflation basically would mean the opposite of inflation, which means that prices of goods within China are falling. Now, why are the prices falling? It means either consumers are not buying or buyers are not coming forward to buy what's there in the market, or there's an oversupply of the goods in the market. There are too many goods and, consumers are not enough again. So that's the scenario which seems bottom line right now with regards to deflation. Prices going down because buyers are not buying. One. Second, you mentioned about, Xi Jinping. So I'll kind of touch on it a bit. When Xi Jinping came to his third term in the Congress last year, the 7-member Politburo, I think, is heavily stacked only with people of national security backgrounds. There is no one, or maybe only one, someone who has a deep background in economics. That, to some observers, indicated then and indicates now maybe that Xi Jinping is laying a higher priority to issues of national security and all around whatever it be, as compared to economics, though I would say that definitely any leader would want a better economy, because the better your economy, the more you have money for other things, whatever, including defense. So that's out there, as a question. Thirdly, with respect to the US and Biden saying, as you said, that China is a ticking time bomb, absolutely is. It's not only China, it's US and China who are together a ticking time bomb in the next maybe 5 odd years or so. All US or several US, scenario war modeling exercises are projecting that 2027 or thereabouts would be a time when China would take action whichever way with regards to Taiwan. And also, it is a window of time. You see, now America is racing. As you mentioned, they put a stop to capital inflows or venture capital, private equity into China. It's never before happened, right? Yes, before this, what America was already doing was had imposed sanctions on technologies and banned American citizens from working in the Chinese semiconductor industry. So that was already going on to, kind of close the tap for China to access technologies and talent. But now even the money is being, stopped whatever America can. The key thing is that it is a race. It's not only a war, it is a race between China and the US to kind of become the leaders in technologies of the future, be it AI, quantum computing, etc. So that's where it's heading with respect to, the competition. But yes, this means that American investments, as you mentioned, China plus one is there, would now be looking for alternative markets. We can come to that a bit later with regards to India. But within China, And with this deflation, the reports today which are out there is of the property, not to say bubble, but property market, uh, uh, whichever way.
It's been actually more than a bubble. In fact, that's a good point to bring up. Let's bring up some pointers about what is happening in the property market in China. The China property market has been for years, viewers, the fastest growing property market both for commercial and residential anywhere across the globe. And if you look at it in broader terms, in terms of the infrastructure development that has happened in China, it clearly surpasses any other country by leaps and bounds. But over the last 2-3 years, and in fact even earlier, some of the largest property companies in China have faced trouble, and the latest is a Evergrande-like crisis for a group called Country Garden. And this is a company that has missed interest payments, and if it were to default, it would have a much broader impact across the housing market. Home prices have already declined 20%, and housing for any economy, any fast developing major economy in the world, including the United States, is a very, very significant sector. It's a barometer of any national economy, because all manner of commodity inputs and services revolve around housing, real estate, and the broader infrastructure piece. And if there's a problem there, it then has a ripple effect through the system. Professor Kondapalli, be that as it may, the question that I want to ask you, and taking off from a comment that Ravinder Sachdev also made, does Xi Jinping not know how to run China's economy, or is he simply not focused on it, and does he sort of enjoy being the head of a band of wolf warriors really in some ways?
As you rightly mentioned, Siddharth, there is a paradigm shift from last 30 years of reform to the last decade of Xi Jinping's rule. Last 3 decades of reform had the strategic guiding principle of what the Chinese call Tao Guang Yang Hui. That is, hide your capabilities, bide for your time, or sometimes translated as keeping a low profile but focusing on economy. So from 78 to 2012, they focused on economy and did not raise much of the security issues other than Taiwan or other sovereignty issues. However, when Xi Jinping came to power, he used the words "fanfa your way," roughly translated as accomplishing something. So the interpretation of this is they're moving away from economic growth rates to that of assertion, China's role in global affairs. That was the focus of Xi Jinping. And we saw grand programs like Belt and Road Initiative launched in 2013. They also had this concept of China Dream. Basically, the lands that China perceived to have lost in 19th century, 18th century, today they want these lands to be back to China. That had pitched China to many states like Vietnam, Philippines, Arunachal Pradesh, Senkaku Islands, or others. So basically, there is a paradigm shift from economics to that of core interests, as they call, focusing on sovereignty and territorial integrity, and as you rightly mentioned, on security related. As you mentioned, the Politburo Standing Committee of 7 members, 5 of them are with Xi Jinping, and even the rest of 2, Chao Lachi and Wang Huning, they also side with Xi Jinping now. They sided with others before, but now it is. So there is an overwhelming support for Xi Jinping in the Politburo Standing Committee, which was kind of tailor-made. And then the other factional leaders were either thrown out or neglected in the decision-making process. In the Politburo, there is a decline from 25 to 24, where Hu Chunhua was dropped from the Politburo membership. Hu Chunhua was the agriculture in charge in the previous term of the 19th Communist Party Congress. And his briefing was how to keep the pork prices constant, because that is the staple diet in China. However, he is now removed and he is part of the consultative body called the CPPCC. With this, there is a lot of discontent, number one, within the industry and commerce. Number two is the Xi Jinping's recent slogan 3 years ago of common prosperity. As a Beijing economics professor mentioned, it is robbing the rich and giving it to the poor, to the peasantry and others. So as a result, the big business like Alibaba, Tencent, Meituan, other companies suffered. They now have to pay $10 billion each or even more to the Common Prosperity Fund, which meant that the big businesses are now getting their slack. And this has resulted in a lot of discontent in the industry and commerce. There are other curbs on the economy, and hence overall situation is that, and the speculation is that Xi Jinping has crossed the limits by shifting from economics to that of security, national security. And the 14th five-year plan and previously the 13th five-year plan, they started focusing more on restructuring the economy towards domestic consumption and focusing on imports rather than exports. So this created also some kind of turbulence in the economic structure. And that is also is said to be the basis for the economic decline that China currently faces. So there are a lot of issues like this. And you rightly also mentioned about the real estate crash, Evergrande and other companies. Their shares have fallen in Hang Seng, in Hong Kong Stock Exchange. Their borrowing from external sources has declined. FDI also has declined. Round tripping, many Chinese businesses do through Hong Kong and other places, that has also declined due to the curbs that were imposed by the government on the economic sector. I'm mentioning real estate because at one time or on a regular basis, China used to give 11% of its GDP for the local governments, mainly in the infrastructure projects, real estate, or others. 11% of $19 trillion, the GDP of China, that's a humongous amount, which has now gone into a decline. So this has created a huge problem at the economic level. I think these are the basic problems that China is currently facing. I would say the paradigm shift from economic reform to that of accomplishing something, as Xi Jinping mentioned, is at the roots of this current decline.
Absolutely. Professor Kondapalli, you touch on several points in that answer. And when I first visited China, viewers, that is when I first learned the meaning of what used to be said those days, that the national bird of China was a crane. And this was a crane that you would see in every single city, including Beijing, with multiple ring roads. And till the eye could see, you would only see construction cranes. I hope you didn't think about the bird. And today, if you see the situation in China, here's what Morgan Stanley has said in the most recent report, because we now will try and focus on what it means for India. We've decoded the troubles in China. Morgan Stanley, the investment bank, has downgraded China and has upgraded India. Now, see the significance of this. For the last couple of years, global leaders, global CEOs, they've all been talking about India +1. and that +1 mostly meant India. China +1 mostly meant India, and in certain pockets it also meant some other countries. But what has Morgan Stanley said? It has upgraded India to overweight from equal. It has downgraded China to equal weight rating. Downgrades for China till a few years ago were completely unimaginable. India has, by the way, risen 5 ranks in the process in the Morgan Stanley view of things. India is now the most preferred market among emerging markets, and Morgan Stanley says India at the start of a long wave boom, China at the end of one. And of course, India's reform stability, the political stability, corporate profits, very strong focus on capital expenditure, primarily by the central government and also by the states, point towards the fact that we will continue to have one of the strongest GDP growth rates anywhere in the world. Ravinder, I am coming to you. US putting fresh curbs, domestic problems, a crackdown on high tech, and other systemic issues in China. Is this an opportunity for India, a fresh one?
Thank you. Absolutely. And maybe I think the operative word here you used is a fresh one. This is China +1 and now a fresh one, right? Definitely it's an opportunity for India, but there are a couple of things to note also. You see, when China goes down, by the way, our exports go down also. China imports, I think, about 70% of its iron ore imports from India. So some of those import-export numbers would also, be pulled down. But otherwise, yes, it is definitely an opportunity for India. At the same time, we have to step forward and take chance of it and grab it. Couple of reasons. One, in terms of China +1 or other relocation of supply chains out of China, Vietnam is a strong competitor and so is Malaysia. India is emerging. Where we have, I think, a better handle is that we are ourselves a big market. So if, let's say, a large American manufacturer uses Vietnam, they'll use it only for a manufacturing to export to someone else. Vietnam market itself is too small a market. Whereas in India, if companies are there, they have a big market in India itself. So that's an advantage we have. One more thing I would add to this whole thing with respect to India, investments would come into India, definitely. But let's remember the world of today is now very different than the world of 1990s when China grew massively. Now, investments will not yield that many number of jobs in the manufacturing sector as it would have yielded back in 90s. Just imagine, a car automotive plant, a Toyota or a Ford or a GM, right, would maybe, employ 5,000 workers way back in 90s. Today, maybe the same plant, the same capex. Yes, the capital expense capex could be the same coming in, but could create maybe only 100 jobs because everything is automated. So therefore, investments will come, could come. We have to, I think, step up and make efforts, but also we should not be complacent, but I think we are, of course, nobody is, that investments into India will convert into more jobs and employment. There will be a gap. India cannot repeat what China and the world had in the 90s and 2000s and last 30 odd years.
Okay, that's a good point. Professor Kondapalli, I turn to you in the context of the latest move by President Joe Biden.